By the end of this video, you'll know exactly whether single family or multifamily is the right first move for you. And I'm going to give you a framework that most investors never learn until it's too late. So grab a seat and let's settle this once and for all. Here's the deal. Every week, I get messages from people who are paralyzed. They saved up $50,000. They read 4 books on real estate. They're ready to jump. But they keep asking the same question. Should I buy one house or try to get a small apartment building? And the problem is, most advice out there doesn't actually answer that question. It just tells you to follow your goals. That's not advice. That's a cop-out. So today, I'm going to give you something better. I'm going to walk you through the actual data, the real trade-offs, and one framework that will make this decision obvious for your specific situation. Let's start with single-family homes. This is where most people begin. And honestly, there's a good reason for that. The entry point is real. You can find solid single-family homes in solid markets for under $200,000. That means a conventional loan with 20% down puts you in the game for $40,000 or less. Now, I'm not saying that's nothing, but compared to multifamily, it's a completely different ballgame. Here's what makes single family work so well for beginners. The financing is simple. You walk into any bank and they know exactly how to lend on a house. Appraisals are straightforward. The loan process takes 30 days and nobody's asking for a business plan. You also have maximum flexibility on exit strategies. Want to fix and flip? You can. Want to hold it as a long-term rental? Easy. Want a house, hack it, and live in it for a couple years? That's the classic beginner move right there. And speaking of that, let me tell you about Marcus. Marcus was a teacher in Columbus, Ohio. He had $60,000 saved and a modest salary. He bought a 3-bedroom house for $180,000, lived in one room, rented the other 2 to roommates. His mortgage with taxes and insurance came out to about $1,100 a month. The roommates paid him $1,400. He lived for free and built equity in an asset that was appreciating. That's the power of single family for beginners. It fits your life. It fits your credit. It fits your first dive into this world. Now, here's where it gets interesting, because single family has limits, and those limits hit faster than most people expect. 1 property, 1 tenant's rent, 1 roof to maintain. When that tenant leaves, your income goes to 0. When that roof needs replacing, that's your entire emergency fund gone. You can mitigate this with good screening and reserves, but the math is what it is. You're relying on 1 income stream from 1 asset. If you're finding this useful so far, hit that subscribe button. I drop videos like this every week, and the next one is going to build directly on this framework. All right, let's talk multifamily. When I say multifamily, I'm talking about anything with 2 to 4 units, a duplex, a triplex, a small fourplex. Anything above 4 units starts to enter commercial real estate territory, and that's a different conversation entirely. Here's why people get excited about multifamily. Economics of scale. You have multiple units generating income. If 1 tenant leaves, you still have 2 or 3 checks coming in. Your vacancy loss is mathematically lower. Your per unit operating costs drop because you're sharing 1 roof, 1 yard, 1 set of utilities for the whole building. A duplex in a decent market might cost $350,000. That 20% down is $70,000. Suddenly, you're looking at a bigger barrier to entry, but here's what you get for that premium. That property might bring in $2,800 a month in gross rent. A comparable single family might rent for $1,800. You're talking about $1,000 more income every single month. Now, the complexity goes up. I'm not going to pretend otherwise. Financing is more involved. You might need a commercial loan or a portfolio lender. The property has to be valued, not just on comparable sales, but on its income potential. That's called cap rate analysis, and it's a skill you have to learn. Management is more demanding too. More tenants means more maintenance calls, more lease agreements, more everything. But here's what most people miss. You can live in 1 unit. Just like Marcus did with his single family, you can house hack a duplex. You rent out the other unit. Your tenant's rent covers your mortgage, and you get all the benefits of multifamily income, economies of scale, and a more resilient asset while you're still living in the property. So which one is better? Here's where I tell you the truth that nobody wants to say out loud. It depends, and the answer has almost nothing to do with the properties and almost everything to do with you. Let me give you the framework. 3 questions. Answer these honestly, and the decision makes itself. Question 1. How much capital do you have access to? If you have under $50,000 for down payment plus reserves, single family is probably your lane. Yes, you can find multifamily with less, but you'll be stretching yourself thin. Thin margins kill beginners. But if you have 60 to 100,000 ready to deploy, multifamily becomes a legitimate option and the economics start favoring it heavily. Question 2. How much time do you have? If you work a full-time job and you want to start investing without quitting your day job, Single family is probably less overwhelming. One tenant, one property, one set of headaches. You can manage a single family rental on a weekend. A duplex with two problem tenants is a different beast. But if you're willing to learn property management, if you're organized and responsive, multifamily gives you more leverage for the time you put in. Question 3. What's your income goal for year one? This is the one nobody asks, but it's the most important. If you're looking for positive cash flow of $500 a month to supplement your salary, a single family in the right market will get you there faster. If you're looking to build a portfolio that generates $4,000 a month within 3 years, you need multifamily economics working in your favor from the start. Here's the reality. A single family investor who buys 3 houses over 5 years has 3 separate loans, 3 separate sets of maintenance, 3 separate tenant relationships. A multifamily investor who buys 1 fourplex has 1 loan, 1 property, 4 income streams. Both can win. But the multifamily path has inherent leverage that compounds over time. Let me give you one more data point. According to BiggerPockets data from their 2023 survey, investors who started with multifamily properties reported an average equity gain of 42% over their first 3 years. Compare that to 31% for single-family starters. That doesn't mean multifamily is automatically better, but it does mean that when you factor in appreciation, forced equity through improvements, and loan paydown, the multifamily math tends to accelerate faster. So here's my take. If you're starting with under $50,000 and you want to learn the ropes without burning out, start with single family. Learn how to find deals. Learn how to manage tenants. Learn how to handle a midnight emergency call when the water heater explodes. Those skills transfer directly to multifamily, and you'll make your mistakes on a smaller scale. But if you have the capital, if you have the time, if you're serious about building real wealth fast, a duplex or fourplex is the superior vehicle. The income is higher. The asset is more resilient, and you still get to house hack your way into it. That's the truth nobody talks about. Both paths work, but the path that works best is the one that matches your capital, your time, and your goals right now. Not your goals in 5 years, your goals today. If this video helped you see things more clearly, do me a favor. Share it with someone who's stuck in that same paralysis right now. And subscribe, because next week I'm going to show you exactly how to analyze a multifamily deal in under 10 minutes. You'll never look at a property the same way again. I'll see you there.